Welcome in, everybody, to another episode of Executive Sessions, where we discuss trends, developments, and other topics surrounding the industrial manufacturing sector. I'm your host today, Clayton Gollin, and we've got a wonderful show lined up for you. Today, we're doing a retrospective, good Lord, on the economy of 2023 to end the year. We want to know what happened throughout the year and why and what challenges and developments have rocked the industrial manufacturing space. And today, we're joined with my star-studded cast here. To my left is Dr. Mike Clark, the director of the Center for Business and Economic Research and an associate professor of economics at the University of Kentucky's Gatton College of Business and Economics. Man, that has got to be a title on a business card.
It has to go over to the back, too.
Yeah, don't flip it over. It's on the back side of it. But Mike used to work as the chief economist for the Legislative Research Commission in Kentucky, and I understand that someone in leadership referred to you as that damn economist.
Well, you got to understand when you're working with public policy that a lot of times as an economist, you're providing information about cost and different types of issues in terms of the feasibility. And at one point, I remember this was years ago. I mean, this was fairly early in my career. We were providing some information to a policymaker, and it wasn't well received. And they went back to their staff and said, "Do we really have to go back to that damn economist?" And it was only said once, but my staff loved it. They thought that was hilarious, and so I've been referred to that by my staff for a really long time after that.
You should just try that on the business card. It might make it easier.
Yeah.
Well, I might become more popular as a result of that.
Damn economist.
Yeah, that would mean going around with a reputation that way.
Make sure you get that Twitter handle.
Yeah. And to my right is a man who needs no introduction. The heavyweight champion of the industrial sector is John Stewart, my co-host, the co-founder of MiddleGround Capital.
Yeah, don't I didn't co-found you, that's for sure.
That's true. We're waiting for the test.
You'd have more hair if that was the case.
Oh. Well, welcome to the show, guys. Thank you both for taking time out of your day to be here. But let's dive in. Let's dive in and learn about the economy, the great economy of 2023. Mike, to lead things off, here's the first question to you. How has the economic situation for 2023 played out so far? And has it played out differently than originally forecasted?
Certainly it's played out differently than what I anticipated. So if we go back to the beginning of 2023, it's helpful to kind of understand the situation that we were facing then. We were really seeing very high levels of inflation, really still kind of, ripple effects associated with the pandemic. I keep looking forward to the time where we're not talking about the effects of the pandemic, but, we're still seeing some of those effects. And really, the inflation was caused by a number of things. And those arguments about, exactly how much different factors contribute to the inflation that we saw. But, supply chain disruptions, stimulus provided a lot of additional savings for consumers that they wouldn't have otherwise had. And just the fact that things were shut down, they had a lot of cash in their pocket from when they weren't spending as much. So all those things kind of converged to create a situation where we had really high rates of inflation. And, of course, the Fed likes to keep inflation around 2% and keep it fairly predictable. So when inflation really started to creep up, that was a significant worry. And really, the Fed was trying to fight inflation by increasing interest rates, of course. And, the idea there is, well, if the Federal Reserve can increase the federal funds rate, that'll translate into higher interest rates for other types of loans, and that will cause it to be more expensive for us to finance our consumption through loans. So, if we were thinking about buying a car, if we were thinking about buying a house, or anything that we might have used debt to fund, it was going to become more expensive as the interest rates went up. And so the idea is that should slow down our demand for some of these goods, some of these purchases that we would make. And that would allow the supply from goods, that firms are producing to kind of catch up to where demand was. So we had really high demand, supply was disrupted. If we could slow down demand, then we can kind of get to a position where maybe those things are imbalanced and we won't see prices being pushed up quite so quickly. So you remember at the beginning of the year, inflation was probably around 8% or so. And so the Fed started, has been increasing rates significantly. And if you were looking to buy a house, you have noticed that the mortgage rates, went from around 3% to over 7%, well over 7% here lately. So interest rates have really gone up. They've been really expensive. And we kind of knew the Fed was being very aggressive in terms of raising interest rates and trying to fight inflation. And of course, the concern, the balance that the Federal Reserve really has to try to achieve here is they want to slow that economy down, but at the same time, they don't want to overdo it. Because if they overdo it, then what it means is it starts to choke off that demand. Consumers start, just pull back on their spending, completely. Firms can't sell the goods that they're producing, and then we might slip into a recession. And so as aggressively as the Fed was cutting back on interest rates, there was a lot of concern, I think, among economists that they might overdo it. And certainly, we're seeing this built into the forecast that a lot of national economists were doing. My expectation was that there was a pretty high probability that we could go into a recession either by the end of 2023 or sometime in 2024. But as we kind of look at what has happened, what we've seen is that the economy has been really resilient. We've continued to see job growth. We've seen GDP, the value of the goods and services that we produce, is a really important broad measure of how the economy is performing. Those have really held up. But at the same time, we have seen inflation come down. Not quite to where we would like it, or not quite to where the Federal Reserve would like it, but we've seen that that inflation rate slow down. So prices are still going up, just not nearly as fast as what we had been seeing. So really what we found is that the economy has been very resilient and really has kind of defied a lot of expectations of some economists, including myself.
Well, so on that note, John, what are you guys seeing over in the industrial side as far as looking at 2023 in like a year in review?
Well, I mean, from the an M&A landscape, since we're a private equity firm, I mean, it's rising interest rates has made it more difficult to borrow money, and so it's slowed down mergers and acquisitions, of companies, and so that's something that we've been challenged with. I mean, typically we do, 5 or 6 transactions a year. We've done 2 platforms this year, because of that. It's not because for us we don't put a lot of debt on our companies, so that's not really a factor, but knowing that the M&A market has slowed down, a lot of people are not bringing their companies to market this year. So I think, we've seen that impact at our companies. We've seen more of their cash flows being used to fund the debt levels that the company has. And so it takes away the cash flow for making investments in the company, making investments in your employees, hiring, and so it impacts those types of things in the businesses. And so we've seen that real impact. We have benefited in our companies, and I think, companies that have a strong balance sheet and are not, highly levered have withstand this situation better than some that were really reliant on the cheap capital that was available for a really long extended period of time, and really didn't think that this situation would ever kind of reverse so quickly, are finding themselves in a difficult situation because they don't have the operating cash flow to service the level of debt that they have on the business due to the rising interest rates.
Well, okay. So on that note, what would you say has been the most surprising economic developments over the year, from your perspective and also from yours? When you look back at it, what were the events, I guess, that kind of caught you all off guard?
I mean, for one, I was a little bit, I don't know if shocked is the right word. I guess I was surprised that the Fed acted so aggressively, because we've been in such a situation where it's almost been like a passive Fed for a long period of time with a lot of things going on, and they've kind of let the markets kind of like, just sort things out. And to see this, progressive policy that they put in place was a little surprising, I think, to a lot of people. It definitely surprised me. I mean, I knew that, especially as we went into the general election, I expected interest rates to go up, and I expect next year, it's going to be like, who knows what's going to happen. But it was more than I anticipated, and so it's definitely had more of an impact than I anticipated it having. The actions that they've taken. Not that I'm saying that their actions have been wrong.
Right.
I think there's like a whole generation. You might even be in that generation that you look at this and you're like, these interest rates, this is crazy, but this is, on in the grand scheme of things, this is probably more of a normalized level than we've seen historically. I don't know. That would be a question for the economist with a long title, but I think we really got used to cheap money, and that was something that I think this country traditionally hasn't really had access to.
No, I think that's true. If you go back and you look at historical interest rates and inflation rates, you really have to go back to around 2000 to see mortgage rates, for example, that are comparable to what we're seeing now. And I'm sure in terms of business loans, you're again the same type of thing. But really, since the housing recession, in 2008 and 2009, we've had a very slow growing economy. It has grown methodically during that time period, but it was relatively slow growth. And we ended up with, very slow, moderate inflation as a result of that, very slow, moderate employment growth during that time period. And we kind of got spoiled, I think, to these really low interest rates. And that was, of course, really great for those who are wanting to borrow. But when the I think when the inflation rate started to really jump up, and they jumped up so quickly, there was a lot of concern about could this spiral out of control. And so I think a lot of folks kind of criticized the Fed for not getting into it quicker than they did. Now, how quickly should they have gotten into it? It's a little bit hard to say. They were kind of signaling that, interest rates were going to be going up, and, kind of communicating some signals to the market in that case. But, when we start seeing inflation rates of 8%, I think, it's kind of like, we really need to be aggressive in terms of these higher interest rates. And they kind of got out of hand a little bit, right? I mean, a lot of the expectation was when the inflation rate started going up, that these were simply supply chain issues, and that supply chain issues would be resolved fairly quickly, and they weren't. And as a result, we've had more persistent inflation than what we've had for really an incredibly long time.
Mm-hmm. Okay, so actually, Mike, I wanted to touch on something that you said at the start of the show. You had talked about it looking like we're going to possibly kind of steer clear of a recession. Potentially, right? I want to put a lot of emphasis that you're not holding a crystal ball and that you're going, yes, I know, there's no recession coming. So I just wanted to put emphasis on that really quick. But John, I do have a question for you. In the industrial manufacturing sector, how has the looming cloud of a recession impacted business development, production, things of that nature?
Well, I think for a lot of industrial manufacturing companies, I think they're taking a more cautious approach to capital investments. Trying to hang on to cash that they have on the balance sheet and being very wary of taking on incremental debt to make capital investments. Because again, the environment was such cheap capital for such a long time that it made it easy to allocate capital because there wasn't a high cost of capital. Products in the market like being able to go out and instead of you want to buy a $5 million piece of machinery. A lot of companies and a lot of products emerged where you didn't have to buy the machinery. You could go out and you would have a company that would buy the machine for you, and then you could pay like a lease. To lease the machine, and then, over a period of time, usually, 5 or 6 years. And at the end of the lease, you have like a $1 buyout. So it's kind of a cheap financing way to do that.
Is it rent to own?
it kind of like that. But, so you like it from a capital standpoint. I mean, even like, the universities, have taken advantage of this. Like the University of Kentucky, for example, you see all these new dorms that are being put up at all these universities. The universities kind of got smart. Instead of using their capital to build new dorms, they let other people use their capital to build dorms on their property and then manage the dorms for them. And then their students get the benefit of all these great, expansive capabilities. Yeah. But again, that was because debt was really cheap, and so people were finding creative ways to do things, to defer capital investment. And then that let the university use capital to do other things. Right. and same thing for companies. So it's impacted everybody. So when debt was cheap, there was a lot of creative solutions that came out. There were alternatives to traditional financing, and I think you're seeing a lot of we're seeing a lot of that go away.
Right.
It's a lot harder. It's a higher degree of threshold. Because typically those products were structured in a way that those people are earning a slightly better rate than they would if the company just borrowed the money to do it. But now with the cost, the base cost of the prime interest rate, being raised higher, it's made that factor. So from going from 1% to 2%, or 1% to 1.1%, a 10% improvement, that's different. But going from 7% to 7.7%, a 10% improvement, it's a magnitude of 7 times more expensive, right? So,
right.
it's made some of those products dry up, and so it's made it harder to find creative ways to put capital to work. And so, it's causing people to really, really evaluate, the investments that they're making in their businesses.
So, okay, well, that all being said, how do you operate in investing and running businesses when you're dealing with that, when debt becomes expensive and not cheap?
Well, my philosophy doesn't really change. I mean, I try to focus on, free cash flow generation at the business. That's the most important factor, is making sure that you're generating good free cash flow in any environment. And so, making sure that you have a good capital, structure, the balance sheet, so that you don't have too much leverage on the business and you're not consuming more of your cash flow with, just interest payments, really impacts the performance of the business. And so we've always kind of looked at it that way, and always kind of take a cautious approach, and always are putting, 50, 60, 70, and sometimes 100%, equity into the deal, and not using as much leverage as a lot of other, financial institutions do when they purchase a company. And so that plays to our benefit. But it has impacted us, because even the lower levels of debt that we have more of our cash flow in our companies that's being consumed by the interest payments that, that they have. And then that's less return that we can have for our shareholders.
I gotcha. Okay. Well, on that note, Mike, I got a quick question for you. How has the manufacturing sector fared in 2023? And would you say that it's similar to other sectors in the economy, or do you see it different?
Well, I think it's been a bit different. One of the major things that we look at in terms of gauging how different sectors are doing is the employment levels in those sectors. And it's not a perfect measure by any means, but one of the advantages of it is it's collected by government agencies. We get it monthly, and so it gives us a kind of a read on how they're doing. But if you look at employment across different sectors, across the nation, what you see is that employment has kind of turned flat in manufacturing, whereas we've continued to grow in terms of our overall total employment. Manufacturing really hasn't kept up. That's different across different subsectors of the manufacturing industry. And different across different states. For example, Kentucky has actually done really well in terms of its manufacturing employment, but nationally it's kind of been somewhat flat. Now there can be a number of issues going on there. Part of it could be again, some companies may still be dealing with uncertain demand, supply chain issues. I think most of those have probably been resolved. Some may be struggling to find workers still, although that seems to improve. Or it seems to have improved, but it can also be kind of structural changes within the companies as well. That manufacturing may be seeing increases in productivity, and so they may be moving more towards capital than labor. Particularly as labor has become more expensive over the past couple of years. But generally, when I look at kind of the manufacturing in terms of employment, what we're kind of seeing is that employment has been stagnating somewhat. You look at some other things like, the PMI for manufacturing. What we've been seeing over the past, few months is that maybe that sector might be contracting a bit. And I don't have good explanations for exactly why that is happening, other than maybe it may be consumers are starting to shift again more towards those services as opposed to consuming goods that are physically manufactured. We certainly see that in terms of evidence in the prices. The price for services have been going up as people have moved away during, after the pandemic. They're purchasing a lot of goods, not services.
Right.
As people went back, about their lives, they started increasing purchases of services as opposed to goods. And so that may have slowed down some of the demand for manufactured goods. And we still may be seeing some of that, although I tend to think that we should start seeing that kind of resolve itself over the next year or so.
John, are you guys seeing the same thing as far as finding people that are willing to work?
It's always challenging in industrial manufacturing to find
Right.
people that want to work. As we've talked on the program before, we try to spend a lot of time, focusing on raising wages, improving working conditions,
Right.
automating tasks, making the processes more efficient, so that we can attract workers into a better working environment and, make it, more appealable. The challenge is that, manufacturing wages really compete with a lot of fast food for workers.
Yeah.
And, when you think about like the effort and the working conditions, it's probably more pleasant to sit at McDonald's and say, do you want fries with that, than it is to, operate a press or, in a factory or some type of machine on second shift. When you don't have to do that, necessarily in the fast food industry. So I think, raising wages is one of the key things. And, we're trying to create a $10, gap between fast food and the wages at our company so that we can attract, better talent and, retain the talent into the facilities, and then trying to modernize and make things more efficient. Again, because there's a lot of underinvestment still in North American manufacturing. A lot of the companies we buy, the technology they're using is, 30, 40 years old, inside
Really?
of in some cases 100 years old.
Oh my God. Okay.
And part of that is that those processes were so good, through the Industrial Revolution, that they actually had a lot of tailwinds and, carried us forward a lot. And,
Right.
and where we buy a lot of family businesses, they don't make upgrades just because something new is available. If if grandpa used it and it still works, they use it.
Yeah.
And so, they take care of it and they use it and it still works. And so a lot of the equipment that you see around here are things that we, pulled out of our facilities that are manual intensive in nature. So, but yeah, that's that's always been a challenge. I don't know that the rising interest rates has really played a big part in that. I agree. I think it's gotten better.
Right.
I think we're seeing things getting better, and some of that money that people had, the government, provided some capital during the COVID situation to people, as supplements for unemployment. And, it was actually hard for the first kind of 12 or 18 months even to get people back to work.
Yeah,
And it
I
wasn't
remember
until
that.
some of that dried up that you're able to get those people back to work. But I think we're pretty much at a state now where, like, if people want to work, they're working. There's probably a percentage of the population, 2.5%. They just don't want to work.
Yeah.
And there's no amount of it that's going to incentivize them. They're going to figure out some other creative way not to have to work.
Yeah.
But I think the people that want to work are working, in my opinion.
Well, okay. Mike, you talked about different areas within manufacturing that had grown, hadn't grown. What areas have you noticed anything that is falling short in the manufacturing world, or?
To be perfectly honest, I haven't looked that deep into it. Of course, being from Kentucky, working with a lot of Kentucky agencies, I tend to look at what's going on in our state quite a bit. And of course, we are heavy in terms of automobile manufacturing, assembly plants and parts and things of that nature. And we've certainly seen our employment improve. And it's been kind of interesting, if you go back and take that long view of how manufacturing employment has changed over time, you go back even 30 years, manufacturing employment had been kind of on a downward trend, partially because of international trade. We were seeing a lot of manufacturing firms, move their facilities outside the U.S. And we saw that for quite a while, even here in Kentucky, where we were losing a lot of things like textile plants and things of that nature. We really didn't have a comparative advantage there. But one of the things that we've seen over the last few years, really a decade or so, is that manufacturing employment, at least in Kentucky, has improved. And, we've kind of bucked the national trend in that. And I think a lot of that has to do with the fact that the type of manufacturing that we're doing, we're not competing for the same types of jobs that we're going overseas. years ago. Now what we're doing is, we are seeing plants, make these significant investments in capital that make workers more productive. And the jobs that we're getting now in terms of manufacturing tend to be more advanced manufacturing, very highly skilled workers who have very high levels of productivity because they're paired up with capital intensive tasks. So we're seeing a lot of really better jobs, better paying jobs in the manufacturing industry. And I think a lot of that, at least in Kentucky, has to do with the fact that, we've got a very strong automotive base here.
Yeah, and then when you look at the automotive industry, to follow up on the doctor's point there is that there's so much capital that is invested in like these facilities. Mm-hmm. It's not easy to like just go and move that, even for these large companies. Yeah. I think when they originally built the Georgetown plant, when I was there, it was like $800 million or something. It was like the original investment.
Whoa.
And that wouldn't touch it today, right? That wouldn't even be close.
Really?
No. That wouldn't even be close to that, and they've invested probably over a couple $2 billion there now. And so, no matter how large a company you are, when you start getting into those types of numbers, it's one of the things that's kind of plagued people like Tesla in trying to expand like their facilities. I mean, they're seeing like, they can have all the money, they have all the money in the world. Right? Like they're, right. Richest guy in the world, most profitable business in the world, most high valued business in the world, all these different things. They got all kinds of capital, right? But they still can't build the plants. You can't get them up and running because, it consumes so much resources. Like, it's just difficult to do. And so it creates a high barrier for, especially the types of jobs that we have in the state, for those to go away. So it's, there's investments that were made, decades ago here in the state are really paying off. And then you have the supplemental jobs, so the suppliers and all of that are around that are supporting those. And then you think about all of those workers and, the housing industry. And so especially in areas around, Louisville and Bowling Green and Lexington and Georgetown and these areas, they almost are insulated a little bit from what's going on around because of that stability that those big economic engines and these big manufacturing, operations. Auto plants are probably some of the largest operating facilities in the world, from a, number of people that are in these facilities. And then you think of all the ancillary jobs. So it creates a lot of stability. And so, I think, credit to, the past, whether you're a Democrat or Republican doesn't really matter. But I think, getting like Toyota here and getting, some of these other investments and, now some of the battery investments that are coming here. And because now the state's known to be able to support that type of manufacturing and that capital investment and all those things has really, paid off and has benefited the state a lot. And so, kudos to, some of the leaders that had the vision to try to attract those types of jobs into the state.
So, okay, well, on that note, you're from what you're describing to me about the automotive industry, that sounds like it's, if anything, like it definitely does provide some sort of insulation. It does kind of help kind of weather the storm around. What areas is the automotive industry one that you would consider that has grown or succeeded within 2023 or?
Oh, it's definitely gotten better in 2023. But again, the auto industry for the first time ever, there was a global shutdown that happened where like everybody was idle for a period of time with COVID.
Was that a car joke?
No.
Idle? Oh, okay.
No. Well, but it could be a car joke. But no, it's just a term that we use sometimes.
Oh.
Idle means not.
I don't get out very often.
Anyway, but no, it could be a car joke. But anyway, it was the first time that had happened, and then really from that point, to now, like there was the chip shortage, and then actually there was a union situation with GM. Then there was the chip shortage. And then, now the supply chain finally got back up. Inventory still not available on the dealer lots.
Oh, no.
Like, if you go to the dealer, there's still no cars available. Like, so there's still a lot of production that needs to happen to get those inventory levels back to like normal levels where you can go buy a car. Like, you can't just go buy a car anymore. You might, you go to buy a car and you got to choose like the one that they have instead of being able to choose what you want. And
right.
So there's still some work that needs to be done to get there. And then, the most recent, union activities, disrupted a little bit mildly, but like I think was very strategic in the way they went. So it's not going to have major implications. But definitely all of our auto companies we've seen, really have the best performance in the last 3 years has been in the last 6 months.
Okay. Well, Mike, same question. From an economist standpoint, what areas have grown and succeeded in 2023?
Well, I think we've seen several where we've had some pretty strong growth. Employment in finance, professional business services, have improved. We've certainly seen leisure and hospitality come back strong as people have gotten out and, again, money in their pocket, being cooped up, people are willing to spend more on travel and things of that nature. So we've seen that come back, not quite as strong as where we were prior to the pandemic, but it has improved. So I think, really as you look across different sectors, you are seeing some very strong employment growth. And now I think we're starting to see some employment growth, particularly in terms of government sectors. And that includes education as well. That had kind of tapered off a bit, but we're starting to see that pick up here, over the last few months.
Okay. Well, so we've talked about the good and the bad. How do you think both the issues that 2023 has brought and the different areas that have grown within 2023, how do you think that that's going to shape the economy and the industrial manufacturing world at large?
Look, I think like the positives are, I think this has been necessary. And, I think if you go back, just even 2 or 3 years ago, there were people that were talking about, the dollar wasn't going to be the kind of global standard anymore. And, we were going to get overtaken by, the Chinese and now I think the view's like completely opposite right now. I think some of the actions that were taken, even though they've been painful, like I don't like paying higher interest rates. Nobody does.
No.
But I think, it was prudent. And, and again, credit, because I can imagine the immense pressure, on the people that like serve, in that capacity, to make those decisions. I mean, they know it's not going to be a popular decision. I mean, everybody wants cheaper interest rates, like everybody. That's like the popular decision. So it's hard. And I think the most hardest hit people have been just like in any kind of economic cycle, is the people that make the least amount of money, And so, a lot of people, even people now that, make a good wage, you can make $100,000 a year right now, and it's kind of challenging to buy a house,
Yes.
Here, in Lexington or, in the area, it can be a challenge, for people to do that. Probably would have never thought that would be the case where, you make 6 figures and you wouldn't be able to have a piece of the American dream, So I think, that's been the unfortunate consequence, is that, the lower end of the earning employment base has been the hardest hit, as it always the case.
Mike, same question.
Yeah, well, I would say, in terms of the lower income, I still, one actual positive that we've seen come out of this is that, with the strong demand for workers and the relatively low supply of workers, we have seen that wage pressure. And a lot of the wage pressure that we saw was actually in the lower paying jobs. And so we saw a lot of workers find that they were able to command a higher wage in the labor market. And the largest wage increases that we've seen over the past year have been in that leisure and hospitality sector. And I think it's because, they were starting to recognize they can jump industries a lot of times. And if they see a better opportunity or a better wage somewhere, simply because, there aren't as many workers available, they've got employers competing for them, they've been able to command this higher wage. I mean, as we kind of start looking at kind of what's going on now, you mentioned the recession. And we kind of anticipated that there might be, a risk of recession, late this year or into 2024. It does seem like, the economy has been really resilient. And, employment has continued to grow. It's slowed, but it's continued to grow. The economy seems to be very strong. The consumer seems to be willing to spend, and that has been really encouraging. And employers, because they've come off this period where it was so hard for them to retain and attract employees, they seem to be very hesitant to let employees go. We don't see a whole lot of layoffs anymore. Claims for unemployment insurance are really, really low nationally. They just seem to want to hold on to their workers. And even though there may be kind of this risk, I don't think we're certainly not guaranteed to avoid a recession. There's still a chance that we could have a recession. It just seems to have diminished in terms of the likelihood. But I think a lot of employers are looking at this from a perspective of, well, sure, there might be a recession. It's probably going to be a short recession if if one comes up. It's probably going to be a relatively mild recession. Do I really want to lose my workers or dismiss my workers for a disruption that could be relatively short? I think a lot of them have decided that we're going to hold on to our workers, even if our demand for our goods and services has gone down a bit. We're going to hold on to those workers because it may be really hard to get them back when things pick up. And I think that has given a lot of resilience to this economy because it's basically kept people working and it's kept them earning a paycheck. And so as a result of that, they've been able to continue to spend and feel comfortable with that spending.
Do you think, just one question for you, do you think that because of all of the disruption we had in the supply chain, chip shortage and all the other supply chain issues related to, the kind of reshoring of work and, all those things that, the political issues and everything that have gone on has, kind of conditioned the environment today where it's easier for these businesses to pass on those costs than it was like previously, because, people are kind of more adjusted to, we got to raise, the argument of we got to raise our prices because, we got to raise our wages. Like that's become like a national argument, right? That we have to do that and that people understand there's a shortage of workers. We have to raise our prices because, the fuel price is going up, right? And people can see that. And, is there a little bit of it's like, just psychological conditioning that people are more open to the fact that, prices are going to fluctuate, because of things that are going on. And again, we were insulated for a long period of time from, we had low gas prices, we had low interest rates, we have all these different things. And now as people are starting to see these things, again, it's just kind of logical that like if gas prices go up, okay, I can understand that the truck that brought this part here is going to cost more. And so it's made companies, swifter to move, to increase prices, based on, the fluctuations, and probably slower to reduce their prices when those costs come down. Like steel is a good example, got up to like a record highs. And, we own companies in the steel industry and, they've been able to keep their margins really high even as steel prices are coming down because, generally you always make the argument that I can increase prices when things are going up, but you don't go back to your consumers and say, hey, those prices that are coming down, I'm going to lower my price again. So I don't know how much of that is like going on out there.
I think there is some of that. As we mentioned earlier, we talked about how there was this period of time where, inflation was pretty predictable, right? I mean, you kind of knew it was going to be just a little bit under 2%. And you built that into your contracts, right? Mm-hmm. I mean, you expected it. So as you were thinking about, cost of living adjustments for your employees, as you were thinking about, raising your prices, we kind of got settled into this period of time. And you kind of knew that, roughly how prices for your inputs might be changing. And when we started seeing the high inflation rates, there was a lot of shock to the system, right? I mean, imagine, we heard this through a lot of contractors, for example. They might have quoted, a project, thinking that lumber was going to be a certain price, or the materials were going to be a certain price, and then suddenly, we started seeing these supply chain disruptions, and we started seeing all this volatility in the price of lumber and in different inputs that we use. Suddenly, they started to realize, I got to be really careful how I build these contracts and build these bids because that's putting a lot of risk on me when I agree to these prices. Mm-hmm. And so I think. Businesses have gotten a little savvier about that because, over that 10, 20-year periods of relatively low inflation, we understood what things were going to be. We could plan and predict relatively well. Now we understand that there may be a lot of volatility and a lot of risk associated with that, and we really have to figure out how to manage that risk as we're, setting our prices, building our contracts, and things of that nature. So, now that we're kind of on the other side of that, we're seeing inflation come down. I do think, there is an expectation for those who are purchasing these things from manufacturing firms or whether that's businesses or consumers purchasing these. I think we kind of understand that, yes, there is a lot of price volatility and, we have come to expect it. Now, it won't be long before we get back into a situation where we're used to that 2% inflation maybe, or maybe 2.5 or, wherever it kind of settles. So we may have to go through this adjustment again. Memories might be short, so we might have to be careful.
Yeah. Okay. Good point.
Okay, we're running lower on time here, so I'm going to jump ahead. Mike, I've got a question for you. What can we expect in 2024?
Well, I think, in terms of 2024, we have a lot of the same things that we thought were going to happen in 2023 in terms of, interest rates have gone up. They've been up for a long time. We anticipated that those would start to have a cooling effect on the economy. I think we're starting to see that. I think we will see more of that as we move into 2024. And by that, I mean, slower spending, slower employment growth, and inflation starting to really come in closer to the Fed's target. It might take us a while to get to, maybe a couple of years to really get to that Fed's target. One of the big questions that I think a lot of businesses are wrestling with is, will the Fed increase rates again? How long will they keep rates up? And that's, of course, really difficult to say. And the Fed is always very cagey about, responding to those types of questions. They don't want to commit to a certain path because they want to be nimble enough to change based on the data that's coming in. And right now it looks like they are comfortable keeping rates high for a while. But as we do start to see that economy slow down, I think that will give the Fed an ability to, maybe stop raising rates. I think conventional wisdom is that maybe there's a possibility of one more rate increase, maybe a small one. But then the question becomes, well, just how long are we going to keep rates at this high level? And I suspect, towards the end of 2024, we might start to see rates start to come down more to kind of their long-term goal as they start to see inflation really come in. The problem is that last part of the inflation, is really hard to really rein in. Generally, I think the economy is fairly resilient right now. I think, we are going to continue to grow, but we will grow at a much slower pace than what we've seen this year.
I think growth is always better than loss. I mean, I'm no economist, but I would, from what I would put together, I would say as long as we're in the black, that's probably a good sign. John, I got a question for you. You mentioned the election earlier. 2024 is a presidential election year. We got a massive potential for change. So how do you think that this could potentially shape the economy and the manufacturing world specifically?
I think it's going to be a big distraction on everybody. I mean, it's been kind of nice not to wake up, whether you're a Democrat or a Republican.
Oh, I know, and campaign ads.
Yeah, and not see these guys in our faces every day. Yeah. I think all of us are just like tired of seeing most of them. Yeah. And so I think it's gonna be a big distraction. I mean, look, we got a person that's probably going to be the nominee on one side of the party that's like, under indictment and, going through this like very, visual trial and, the situation, which is just like unprecedented to happen, during an election. And then, we have, a president on the other side that, age is definitely an issue, with a lot of voters and, thinking about that. There's no real other contenders that have emerged in either party that give, an alternative, to, some of these selections. And, and again, I think it's just going to be a big distraction on, a lot of people's time. I think like it's going to be very hard to turn the television on without hearing something about, the election. And like what's going in one of these candidates and, and some of the, antics that, that are involved in all of that. So, I think it's going to be very distracting. I hope the Fed continues to do a good job. I think they've done a good job. I hope they stay focused and don't get into, any of the politicalness. It's supposed to be, the Fed's supposed to be non-political. And, I think it would be easier for, any, administration to have like interest rates declining and, that kind of thing because, the president kind of gets beat up based on the actions that the Fed takes under their leadership, but they really shouldn't have any impact. And so I hope they stay focused and stay with what they're doing. I think, they've been pretty level headed and they've resisted, a lot of the pressure, and there's been lots of pressure, to slow things down. How many times have like they forecasted that they're not going to do, we think they're not going to, and then, thinking that this is going to put pressure and set an expectation. And no, they've just going to continue with their plan. So I think, for them to do that, is going to be important. And then for the rest of us, just stay focused as well, throughout this time, because it can be very distracting on everybody.
John, I'm kind of curious on your opinion. One of the things that I worry about, worry about, it's not the right word, or way to describe it. I think about businesses during an election year, where you got a very stark difference in terms of the types of policies, that might be coming forward. And we talked a little bit about risk, and it seems to me that, when there's a potential for a major shift in policy, one that maybe favors deregulation as opposed to, higher levels of regulation, that creates a lot of uncertainty for businesses. And as they're thinking about investments that they're going to make, specifically the levels of investments and the types of investments that they're going to make, it seems like that's just another source of risk that may cause them pause for a period of time as they start to maybe be careful about making investments. They may have to pull back, or that may not be as wise, depending on the outcome of the election. Is that fair?
Yeah, no, I think you're exactly right. I think it's prudent. I think that's prudent action, that you have to take. We've been having board meetings with our CEOs, and it's one of the things I've been telling all of them is that, making a capital decision today going into 2024 in the environment that we're in is completely different, if we bought the company 3 years ago and how we made a capital decision 3 years ago. And so, yes, that may have been our plan, 3 years ago that we're going to do this year. But, I think you got to take another look and say, does it still make sense, for us to do that? And, you can't have blinders on and just say, oh, well, these are what our plans were. I think you have to be prudent. And, again, I think anytime you're allocating capital that you need to really think about, the cost of capital and the impact that it could have on your business. And so I think that those are prudent actions for managers to take. And I think it's going to have an impact this year. Definitely it is in our companies, and it's something that we're thinking about. And again, it's not it's not like we'll do the Democrats stay in office or the Republicans. It's really like there's some level of uncertainty, and that impacts like key decisions that are being made. There's some administrations that are more bullish on like alternative, energy, methods. And, so there's whole industries, that like, are in limbo land on like, is this incentive program that was in place, is it going to continue? And then, this massive infrastructure spending, there's really not been a lot of infrastructure spending yet, right? Because it takes so long for like, those things to take. So there's this massive infrastructure, funding that's available, but how that rolls out and how it actually impacts the economy still hasn't fully materialized. And so I think there's a lot of wait and see. Is it going to be business as usual like the current administration stays in, or is there going to be some change of thinking that all of a sudden changes the direction for those things? So again, it kind of puts some areas in like limbo land, and I think then people are kind of sitting on the fence and waiting to see what's going to happen. So it's but there's always something going on, to be honest with you. Always. There's always people like, oh, well, what am I supposed to do? Well, you're supposed to do the same thing you're always supposed to do. Yeah. You're supposed to evaluate the risks. You're supposed to make, sound business judgments, and you're supposed to focus on the things that you can control. And, the things that you can't control, there's no need to worry about them because you can't control them. Right. And so you just need to put yourself in a situation where you can be flexible and respond to whatever happens.
True words were never spoken. And on that note, that's going to wrap it up for us today. Thank you all for joining us for another episode of Executive Sessions. And make sure to subscribe to our YouTube channel and hit that notification bell so you never miss an episode. A big thanks again to Dr. Mike Clark, who I can't go through your business title. We'll run out of time. And John Stewart for taking time out of their busy schedules to be here with us today. I also want to give a huge shout out to Noah Day, Clark Freeman, John Stewart, and Andrew Umvericht. Behind the scenes, you can't see them, but they make all of this come to life. But that'll do it here for us today. Join us next time when we discuss more about trends, developments, and other exciting news surrounding the industrial manufacturing world. We'll see you then.